Welcome back. Today we're looking at a really bullish piece on Datavault AI, ticker DVLT.
Right, the one calling it a massive breakout opportunity.
Exactly. It leans heavily on that 18% single-day jump, 400% revenue growth, and this new, very optimistic $7 price target.
Yeah, the energy is high, and the data points, like 50 million shares traded, they definitely grab your attention.
But the core tension, I think, is the huge gap between the consensus price target, which is around $3, and this much higher $7 bull case the writer is pushing for.
And that's the first place to strengthen the argument. The piece really has to work to validate that higher target specifically.
Right.
The weakness is that by just contrasting the $3 consensus with the $7 bull case, it sort of risks cherry picking. It doesn't explain why we should weigh this new thesis more heavily.
So what's the suggestion?
Bolster the connection. You have this incredible 400% revenue growth number. You need to link that directly to the specific assumptions that justify a valuation that's more than double the consensus.
Okay, so give some concrete examples.
For instance, you could detail which of the new contracts the $7 model is counting on, or maybe break down how much market share they need to capture in the AI space to hit that number versus the baseline $3 model.
I see. It's about showing the work. Now let's talk about risk. The writer does mention that DVLT isn't profitable yet.
Yeah, they note the negative PE.
Problem. Integrating risk more robustly is how you build trust, especially with more skeptical readers.
So the weakness is that by minimizing that risk, it might alienate part of the audience.
Exactly. The suggestion is to integrate those risk factors with a bit more due diligence. Instead of just saying negative PE, quantify the reinvestment strategy.
Look at the balance sheet.
Right. Is the company's current cash runway actually enough to fund that 400% growth without, immediate shareholder dilution? It shows you've considered the downside.
I agree on transparency, but the writer is clearly going for urgency. Wouldn't digging deep into the cash runway kind of dilute that momentum they're trying to build?
Well, that idea of momentum actually leads right into the third point, which is about structure.
Okay.
The piece lists out the main catalysts very quickly. You get the breakout, the rating, the growth, the target, the earnings, all at once.
It's a lot.
Yeah. The weakness is that it creates information overload. It minimizes the causal link between the fundamentals, that 400% growth, and the market's reaction.
So you're saying reorder it?
I think so, yeah. The suggestion is to create a narrative flow. Make the strongest data point the foundational why.
Start with the growth.
Exactly. Lead with the 400% growth as the reason analysts are giving it a buy rating. Then you can frame the 18% stock jump as the market reacting to that growth and getting ahead of the November 17th earnings. It builds a much stronger sense of conviction.
That makes a lot of sense. Okay, so let's wrap this up. We covered 3 main actionable points. First, you really need to bolster the case for that $7 target over the consensus. Show the specific data.
Right.
Second, integrate the risks more deeply. Don't just mention the negative PE. Talk about things like the cash runway.
And third, restructure that list of catalysts. Build a narrative starting with the fundamental growth drivers to create a more logical sense of momentum.
Yep. If you implement these suggestions, this analysis goes from being high energy to being deeply persuasive. It'll make the whole piece feel more robust and just incredibly well supported. We'd encourage you to refine it and please submit it back to us.